I want to start today with a conversation that I've had more times than I can count. A business owner sits down, the tax return's done, and I read them the number. And then there's a pause. And it's not because they didn't know that there would be a tax bill, but because the number is bigger than they expected. And the question that follows is almost always the same. How is it that high? It was not even a great year. And sometimes it's actually the opposite. You know, Jen, we had a really great year. We worked hard. Why does the bill feel like a punishment? And you know, both of those reactions come from exactly the same place. A gap between what the business owner was watching during the year and what was actually building in the background. So today I want to talk about how we close that gap completely. And by the end of this video, you're going to understand exactly how income tax is calculated in Australia, why it keeps catching business owners off guard, even when they think they're across it, and a clear step-by-step action plan for getting ahead of it before it's too late to change the outcome. So hi, I'm Jen Richardson and I'm the founder of 123 Financial Group. We work with small business owners across trades, construction and the service industry. And this conversation about a tax bill is one of the most consistent ones that I have. Not because business owners are careless with money, but because nobody ever sat down with them and explained how income tax actually works and in plain language. So that is what we're going to do today. No jargon, no complicated formulas, just a clear explanation of what is happening. A real example of what it looks like in a business like yours and a practical plan for what to do about it. So let me start at the foundation because this is where most of the confusion lives. As a business owner, your income tax is not calculated on your revenue. It's calculated on your taxable income. And taxable income is your profit after legitimate business expenses have been deducted. So it's revenue minus allowable deductions is what equals taxable income. That is the number that tax is charged on. Now, the rate that applies depends on how your business is structured, and understanding the difference between the two most common structures is really important. So if you're a sole trader or in a partnership, your business income is added to any other personal income you earn, and you pay tax at the individual marginal rate. In Australia right now, those rates work like this. The first $18,200 you earn is tax-free. That is what's called your tax-free threshold. From $18,201 to $45,000, you will pay 16 cents in the dollar. And from $45,001 to $135,000, you'll pay 30 cents in every dollar that you earn. And of course, from $135,001 to $190,000, you pay 37% or 37 cents in the dollar. And from $190,000 on, you will pay 45 cents in the dollar. On top of that, most people pay the Medicare levy, which is 2%. Now, here is the part that trips up a lot of people. If your taxable income is $120,000, you are not paying 30% on the whole $120,000. You pay nothing on the first $18,200. You pay 16% on the next slice up to $45,000, and you only pay 30% on the income above the $45,000. The tax system is what we call a progressive tax system. You move through the brackets as your income increases. The marginal rate only applies to the income that sits above each threshold. This is genuinely common misunderstanding. Business owners hear that they are in the 30% tax bracket and assume they owe 30% on everything. And that is not how it works. And understanding that changes how you think about your position. But what if you operate through a company? So your company pays a flat rate on its taxable income. For most small businesses with a turnover under 50 million, that rate is currently 25 cents in the dollar. Now that sounds simpler, but here is an important second layer. When profit comes out of the company to you personally, whether it is in the form of wages or as dividend, that income is also taxed in your hands at your individual marginal rate. The company's already paid 25% tax on that profit, and those are franking credits which attach to your dividend, which the tax office reconciles at the end of the year. The point is this: the money does not escape tax just because it sits in a company. The structure affects the timing and the rate, but the tax obligation is still there. So if you're not sure which structure you are in or what rate applies to you, that's the very first conversation you have to have with your accountant. You cannot estimate what you owe if you do not know what rate you are working with. So let me make this real for you with an example. Say you run a trades business. Over the financial year, the business invoices $750,000 in revenue. On the surface, that sounds really strong. But now let's look at what comes out. So you've got materials and subcontractors at $320,000, wages, including your own wage, $180,000, vehicle costs, fuel, insurance, tools, well, let's say that's $55,000, software, accounting fees and other overheads, $35,000. So that gives you total expenses of $590,000. That means your taxable income is $160,000. Now, if that business is running through a company, the tax at 25% on $160,000 is $40,000. If it is a sole trader, depending on other income, the tax could be closer to $44,000 once the Medicare levy is included. Now, here's the part that matters. Throughout the year, the bank account showed $750,000 coming in, and the owner was paying costs out as they went, drawing wages, keeping everything moving, and the bank balance looked reasonable most of the time. But nobody was tracking the profit building up month by month. Nobody was calculating the tax accumulating on that profit. You know, I sat down with a business owner last year who had $180,000 in the bank at the end of June, and genuinely, he felt like the year had gone well. When we went through it properly though, $40,000 was GST owing on the next BAS, $47,000 was the income tax bill, and there was a $30,000 equipment payment due in July. The available cash was nowhere near what the bank balance suggested. That is not a cash flow problem. That is a visibility problem, and it is entirely fixable. So some of you watching already understand that tax is based on profit. You've been in business for years and you are still getting caught. There are the three reasons that this keeps happening, and none of them really are about financial literacy. First, the bank balance gives you a false sense of security. The bank balance is the number most business owners check every morning. When it looks healthy, everything feels fine. But as the example just showed, sitting inside that balance is GST not yet paid, upcoming expenses and income tax that has been accumulating on every dollar of profit all year. The balance tells you how much is there. It does not tell you how much is actually available to spend. The second problem is PAYG installments, lag behind a growing business. So if you pay PAYG installments, you might feel like you are covered, but installments are calculated based on the previous year's tax liability. So if the business is growing, those installments are not keeping pace with what you actually owe this year. Business owners who are paying faithfully every quarter still arrive at a significant top-up bill at the end because the base figure was calculated on a smaller business. And the third thing is you only look at profit and have a conversation about that after the 30th of June each year. For most business owners, the first accurate profit figure they see for the year is the one their accountant shows them when the return is being prepared. By then, well, the year's already closed. There is nothing left to influence. You're not planning, you are receiving a result and writing a check. And that is the piece that has to change. So here are 6 concrete steps in order of priority. Work through these and then the end of the year bill stops being a shock. So step number 1 is understand your structure and your rate. If you are not completely clear on whether you are a sole trader or a company, or what tax rate applies to your situation, well, that's the first conversation to have with your accountant. Ask them to explain it in plain language. What structure are you in? What rate does the business pay? And what rate do you pay personally on what you draw out? One conversation gives you the foundation for everything else. Step number 2 is to pull your profit and loss from zero every quarter as a minimum. So log into Xero, go to the reports and pull the profit and loss for the financial year to date. Look at 3 numbers for me. I want you to look at total revenue, total expenses, and net profit. Do this at least October, January, April, and June. 10 minutes, 4 times a year. It's not hard. So once you have the profit figure, apply your approximate tax rate to that to get a rough estimate of your liability. It does not need to be exact. You just need to be in the right order of magnitude. That estimate changes everything about how you manage cash for the rest of the year. And step number 3 is open a dedicated tax account and fund it monthly. So each month, move a percentage of your estimated net profit into a separate bank account. Name it something that makes it obvious the money is spoken for. A rough starting guide is sole traders should aim to set aside around 30% of net profit to cover income tax and Medicare. Companies should set aside around 25% for company tax, with an additional allowance if you are drawing dividends or a salary that sits in the higher tax brackets. Ask your accountant for more precise figures for your situation, then automate the transfer. So when your bill arrives, the money's already there. It stops being a crisis and becomes a planned event. That shift alone changes the emotional experience of running a business. And so step number 4 is check and vary your PAYG installments if you need to. So most business owners do not know this, but you can vary your PAYG installments through the ATO if you believe your income this year will be materially different to the year the installments are based on. You do this through your activity statement in MyGov or on the ATO online services portal. If your business has grown significantly in the last 12 months, call your accountant and ask whether your current instalment rate still makes sense. That one question could save you from a significant surprise at the end of the year. Step 5 is to understand which deductions you are actually entitled to claim. Your taxable income is revenue minus allowable deductions, so knowing what you can legitimately deduct has a direct impact on your tax position. Superannuation is worth understanding in particular because contributions you make to your own super before June 30 are generally tax deductible, subject to what we call concessional contribution caps, which currently is $30,000 per year. It does go up on the 1st of July 2026 to $32,500. So for a sole trader in the 30% tax bracket, a $10,000 super contribution reduces your taxable income by $10,000 and saves you around $3,000 in tax. You know what? That's not a small amount, and it is building your retirement at the same time. The key, of course, is knowing what is available and making those decisions before the year closes. Because once 30 June passes, that window is shut. And the last step, step 6, is have a mid-year planning conversation with your accountant. So around January or February is a good time. So book a short meeting specifically to look at where the year is tracking. Not to prepare the return, just to review the profit position. Check whether installments are adequate and identify whether there are planning opportunities before June 30. At that point, there are still 6 months of the financial year left. There's still plenty of time to make decisions around timing of expenses, equipment purchases, superannuation, and so much more. By May, the options are much more limited. By July, they're gone completely. The business owners who stop being surprised by their tax bill are not doing anything exotic. They're just having this conversation 6 months earlier than everyone else is. So for most business owners, the accountant is the person you hear from once a year. The return gets done, the bill gets paid, and that is the relationship until next June. That works fine for compliance. It keeps you lodged on time and on the right side of the ATO, but it does nothing to help you plan, make better decisions, or change the outcome before it is locked in. The difference between a reactive accounting relationship and a proactive one is timing. The December check-in, the February conversations, the questions in April about whether a piece of equipment is worth buying before or after June 30. None of those conversations are dramatic, but together they shape a very different result. So before we close, here is a question worth actually thinking about. Right now, do you know roughly what your profit is for this financial year to date? Not revenue, but profit, the number your tax bill will be calculated on. If the answer is yes, well, great, you are ahead of most business owners. But if the answer is no or not really, that is the gap we have been talking about today. And every step in this video is designed to close it. So if this video has made you want to get a clearer picture on where your business actually stands financially, I've created a free tool called the Profit Engine Scorecard. 15 questions, about 10 minutes to complete, across 3 areas. How clearly you understand your numbers, how well your financial structure is set up, and whether your business is actually building profit. And at the end, you get a score and a clear sense of where to focus first. The link is in the description. Download it, go through it honestly, and let it show you where the work is. And of course, if you go through the scorecard and want help closing your gaps, particularly around your tax position, your profit visibility, or your financial structure, that's exactly what we do here at 123 Financial Group. We work with small business owners in Newcastle and across Australia. The clarity call in the description is a straightforward conversation about where your business is sitting and whether we are the right fit to help. No pressure, no pictures, just an honest look at the numbers together. Of course, it's important to remember that the information in this video is general in nature and it does not take into account your personal or business circumstances. Tax rates and thresholds mentioned are current as at the time of recording, but are subject to change. Please seek professional advice before making any financial decisions. And it is important to remember that your tax bill should not be a surprise. It should be a number you have been watching all year with money already set aside and plan already in place. That is exactly what changes the experience of running a business completely. Give this video a like if it helped and subscribe, because next week we are talking about cash flow, specifically why businesses that are genuinely busy still feel like they're constantly chasing money. It's one of the most common things I hear, and the answer surprises most people. Your business should support your life. So I'll see you in the next video.